Wednesday evening, February 25th, 2026. What happened today in the silver market is something that I believe will be studied for a very long time, and I want to take you through it carefully, methodically, with every number sourced and every claim clearly separated between what is confirmed and what is alleged. Because today we got three things happening simultaneously that have never lined up like this before. Silver blew past $91 an ounce. The CME halted all metals trading for 90 minutes. And this is all happening exactly 36 hours before March 1st notice day. If you understand what those three things mean individually, you understand why their convergence matters. If you understand why their convergence matters, you understand why this channel exists. Let me start with the price action because it sets the stage for everything else. Silver opened the Asian session already moving. By 2:23 a.m. Eastern, silver was trading at $90.71, already up nearly 3% from yesterday's close. By 9:15 a.m., Fortune had it at $90.75, up $2.88 from the prior morning. By 9:35 a.m., FX Street recorded $90.96, up 4.19% from Tuesday's close of $87.30. Through the afternoon session, the metal pushed even higher, with JM Bullion recording an intraday high of $91.83. CNBC's real-time ticker showed a day range of 86.50 to 91.18. To put this in context, exactly 1 year ago today, silver was trading at $31.74. That means if you bought silver 1 year ago and held it, you are sitting on a 186% gain. Silver has nearly tripled in 12 months. Year to date, silver is up approximately 28%. But the trajectory in the past 5 sessions is what catches your attention. Friday, February 20th, silver closed at $80.46. Monday, it gapped up to $84.65 and ran to $88. Tuesday, it consolidated around $87.30. Today, it pushed through $91. That is a 13% move in 3 trading sessions on a commodity that is already up nearly 200% on the year. That is not normal behavior for a commodity market. That is not random. That is a market that is trying to tell you something about the physical supply and demand picture that the daily noise obscures. What is also worth noting is that silver is dramatically outperforming every major asset class over the past 12 months. The S&P 500 is up roughly 8%. Bitcoin is up about 35%. Gold is up around 44%. Silver is up 186%. The Silver Miners ETF, SIL, returned 142% in 2025 alone. There is no other liquid, publicly traded asset class on Earth that has delivered these kinds of returns over the last year. And the analysts at the largest banks in the world are telling you the move is not over. Gold was strong today, but nowhere near silver's pace. Gold traded up to $5,209.80, gaining $33.50 on the day, roughly 0.65%. The gold-silver ratio compressed to 57.06, down from 59.16 just yesterday. 18 months ago, that ratio was above 80. The compression is relentless, and it is telling you that silver is dramatically outperforming gold on a relative basis. This kind of ratio compression historically occurs during the acceleration phase of precious metals bull markets. J.P. Morgan raised their gold price target today, published on Kitco on February 25th. Their new year-end 2026 target is $6,300 per ounce. That is a 22% gain from current levels. Goldman Sachs holds a $5,400 target. Bank of America has $6,000. ANZ projects gold hitting $5,800 in Q2. Every major bank on the planet is now publicly forecasting significantly higher gold prices. And if gold goes where these targets suggest, and if the gold-silver ratio continues compressing toward the 40 to 50 range that is typical of late-stage bull markets, you can do the math on what that implies for silver. I will let you run those numbers yourself. Now, let me tell you what happened at 12:15 p.m. Central Time today. Because this is the part that is going to dominate every precious metals channel, every forum, every Twitter thread tonight, and for the next several days. CME Group halted all metals futures and options trading on the Globex platform. Gold, silver, copper, platinum, palladium, all frozen. The exchange cited technical issues with absolutely no further elaboration. Their status page simply read, "Investigating." Reuters confirmed CME's support team was looking into it. Bloomberg described it as a brief halt due to technical issues. Natural gas was also halted but resumed after about 35 minutes. Metals remained frozen for approximately 90 minutes. Pre-open was set for 1:31 p.m. Central. Full trading resumed at 1:45 p.m. Central. All-day orders with today's date were canceled. All GTD orders dated February 25th were canceled. GTC orders remained working. Let me tell you what 90 minutes of frozen metals trading means in practice. Every mining company that uses COMEX futures to hedge their production was unable to adjust positions. Every bullion bank managing a physical delivery book was unable to offset risk. Every institutional fund running a metals portfolio was flying blind. Every market maker providing liquidity and options was unable to delta hedge. For 90 minutes, the world's primary price discovery mechanism for gold, silver, copper, platinum, and palladium simply did not exist. The ripple effects extend to the London bullion market, to the Shanghai Futures Exchange, to every dealer and refiner and fabricator on the planet that uses COMEX as a pricing benchmark. This is not a minor inconvenience. This is a disruption to the foundational infrastructure of global metals trading. CME Group stock fell 2 to 3% on the day. Nikki Shields, head of metals strategy at MKS PAMP, told Bloomberg it was a bad time to freeze into the close, noting that everyone using futures for pricing and hedging was affected. MKS PAMP is one of the world's largest precious metals trading and refining operations. And when their head of metals strategy publicly says, this is a bad time for this to happen, that is the institutional red. Now here's where I need to be very precise. The CME says this was a technical issue. I have no evidence that contradicts that statement. Technical issues happen. Exchanges have outages. That is a fact of market infrastructure. Servers crash, software has bugs, network equipment fails. Anyone who has worked in technology understands this. But I also have a responsibility to present you with the full context and the full timeline so you can evaluate this for yourself, because context matters. And the context surrounding this particular technical issue is extraordinary. The last time CME halted metals trading was November 27th and 28th, 2025. 3 months ago. That halt was far more severe. A cooling system failure at CyrusOne's CHI-1 data center in Aurora, Illinois, froze all CME Globex markets globally for over 10 hours. Not just metals, everything. The root cause, which CyrusOne admitted on December 6th, was human error. Staff failed to drain cooling towers ahead of freezing temperatures. A cascade failure began at 3:40 a.m. Central on November 27th, a full 17 hours before the halt notice went out. Internal data center temperatures reportedly exceeded 100 degrees Fahrenheit. Here is the detail that matters. November 28th was first notice day for the December silver contract. Silver's pre-halt price was approximately $53.26. By the close of November 28th, after trading resumed, silver had already jumped to $56.45. By November 30th, it hit $57.03. Then the parabolic move began. $65 by December 17th. $79.28 by December 26th, $109.10 by January 26th, and the all-time high of $121.67 on January 29th. That is a 127% gain in 62 days from the halt. The November halt occurred on first notice day. Today's halt occurs 36 hours before first notice day. The November halt preceded a 127% rally. Whether today's halt will precede anything similar is not something I can predict, and I will not try. What I can tell you is that the pattern recognition is impossible to ignore, and the precious metals community is already drawing the parallel loudly. Behind the November halt, there is a story that has circulated widely in precious metal circles. Goldbroker.com, specifically analyst Cyril Joubert, writing on December 2nd, reported that Chinese sources close to the Shanghai Gold Exchange and Shanghai Futures Exchange revealed a buy order for 400 million ounces of silver, with a simultaneous COMEX delivery demand of 7,330 contracts, representing 36.65 million ounces at a 3 to 4% premium. The alleged buyer was China Chengtong Holdings Group, a state-backed entity that controls much of China's silver industry chain. SD Bullion confirmed that JP Morgan shifted roughly 13.4 million ounces from eligible to registered around the same time. Let me be absolutely clear. None of this has been confirmed by CME, CFTC, or any mainstream financial outlet. It remains an unverified market rumor from precious metals community sources. The delivery volume data appears sourced from actual COMEX reports, but the identity of the buyer and the specific circumstances are alleged, not proven. That matters. You need to know the difference between what is confirmed and what is claimed. Now let me connect all of this to the current COMEX delivery situation, because this is where the math gets very uncomfortable for anyone short silver on paper. On March 1st, notice day is February 27th. That is Friday. 2 days from right now, March open interest currently stands at 22,966 contracts. That is equivalent to approximately 114.8 million ounces of silver at 5,000 ounces per contract. Now that number is down dramatically from roughly 85,800 contracts in early February, reflecting the March to May roll that has been happening over the past several weeks. Most of that open interest has rolled into May, which now stands at 70,172 contracts. But here's the problem. COMEX registered silver, the metal that is specifically warranted and available for futures delivery, stands at approximately 87 million ounces. 114.8 million ounces of paper claims against 87 million ounces of deliverable metal. That is a 27.8 million ounce gap. Paper exceeds physical by roughly 32%. Heavy Metal Stats, which tracks COMEX data in real time, rates the current coverage ratio as, quote, stress, unquote. The registered inventory decline has been staggering. In October 2025, COMEX held 167.7 million ounces registered. By February 5th, that had fallen to 103.5 million. On February 11th, registered broke below the psychologically critical 100 million ounce level with a single-day drop of 3.26 million ounces, reported by CoinWeek, citing official COMEX depository data. We are now at 87 million. That is a 48% decline in registered silver in under 5 months. Nearly half the deliverable silver has physically left COMEX vaults. Total COMEX warehouse stocks, including eligible silver, sit around 364 million ounces. 87 million registered plus 277 million eligible. The distinction matters enormously. Eligible silver belongs to specific owners who have deposited it at COMEX-approved vaults, but have not warranted it for delivery. Converting eligible to registered takes only 24 to 48 hours, but requires the owner's consent. You cannot force eligible metal into the delivery process. The COMEX maintains force majeure provisions and emergency trading procedures. Cash settlement is always an option. One analyst at Seeking Alpha has assessed the probability of a formal COMEX default at 0%. But the directional trend in inventories is unambiguous and accelerating. Total 2025 COMEX silver deliveries doubled from 203 million ounces in 2024 to 474 million ounces. January 2026 alone saw 49.4 million ounces delivered, more than 7 times the January 2024 level. London silver lease rates have spiked to 34.9% annualized, with intraday peaks of 39%. Those lease rates tell you that physical silver in London is extraordinarily difficult to borrow. When it costs 35% per year to borrow silver, the market is screaming that available supply is thin. Now, let me give you the institutional perspective, because today we got a remarkable piece of analysis from someone whose credentials demand attention. Robert Gottlieb posted on LinkedIn this afternoon as silver was pushing through $90. And his read on the market was not panic, it was constructive calm. Robert Gottlieb is not a random commentator. He's a former managing director of precious metals trading and sales at Citibank, HSBC, Bear Stearns, J.P. Morgan, and Koch Supply and Trading. He managed one of the world's largest CME London arbitrage books. He provided technical gold expertise to the World Gold Council during the launch of GLD, the largest gold ETF on the planet. His book, Mastering Gold and Silver Markets, Insights from a Legendary Bullion Bank Trader, was published by Wiley exactly 1 week ago on February 18th. This is a man who has spent decades on the institutional side of the metals market. When he speaks about delivery mechanics and market structure, he is not speculating, he is speaking from direct operational experience. His assessment today was that silver's push through $90 is happening against a backdrop of, and I quote, orderly market structure, not stress. He characterized the March to May roll as smooth and disciplined. He noted that March open interest dropped approximately 14,000 contracts in a single session to 22,966, with volume rebuilding steadily to 125,447 contracts. He pointed out that open interest remains approximately 30,000 contracts below January 29th levels, meaning the trade is far less crowded than it was during the parabolic spike. And this is an important point that gets lost in the headline noise. When silver hit 121 in January, the market was crowded with leveraged speculative longs. Open interest was bloated. When the margin hikes came and the liquidation cascade started, 368,561 contracts traded in a single session on January 30th. That was the violent washout that flushed leverage and weak longs from the system. By February 19th, volume had fallen to a recent low of approximately 60,000 contracts, signaling a complete reset in positioning. Since then, volume has steadily rebuilt while price has quietly consolidated and worked higher. Gottlieb noted 4 days ago that $83 represented key technical resistance on the 6-month chart, and that a sustained break above would trigger momentum buying. Silver has now blown through 83, through 88, through 90, and is testing 92. Every resistance level is falling. He described the current rally as healthier and less crowded. His conclusion was direct. With leverage reduced, positioning lighter, and physical deficits ongoing, the foundation for a sustained move higher in silver is strengthening. His major takeaway, which he highlighted at the bottom of his post, was that this rally is being driven by a healthier and less crowded market structure following January's washout. With China back in the market, leverage reduced and structural deficits still firmly in place, the conditions support continuation, not reversal. This is significant because it represents the institutional bullion banking community, validating the fundamental thesis that drives the physical silver narrative. When a former managing director of precious metals at 4 different bullion banks says the foundation for higher prices is strengthening, that carries weight that no retail analyst can replicate. It does not guarantee higher prices. Markets can do anything in the short term. But it means the structural argument for silver is no longer confined to alternative media and precious metals forums. It has penetrated the institutional consensus. Let me now give you 3 macro catalysts that fired today and are compounding the metals bid. First, the tariff situation. The Supreme Court struck down Trump's IEEPA-based Liberation Day tariffs on February 20th in a landmark 6-3 ruling. That created an estimated $160 billion fiscal hole from potential refund claims. Trump pivoted immediately to Section 122 of the Trade Act of 1974, imposing a 15% blanket import surcharge effective February 24th, though U.S. Customs initially collected at 10%, with a higher rate coming later. The constitutional battle over tariff authority is creating enormous dollar uncertainty, which is exactly the environment that pushes capital into hard assets. The EU expects the U.S. to ease metals tariffs in coming weeks, but the legal ambiguity itself is the catalyst. Second, Trump delivered the longest State of the Union address in television history last night. 1 hour and 48 minutes. He doubled down on protectionism. He suggested tariffs could replace the modern income tax system. He criticized the Supreme Court tariff ruling with the justices sitting feet away. He did not mention the national debt, which is approaching $39 trillion. Markets responded with a flight into precious metals this morning. Third, from Shanghai. The Shanghai Futures Exchange has mandated that all non-hedged silver positions must be closed or converted by February 28th, which is Saturday, 3 days from now. Margin requirements have been raised to 22%. This is forcing massive institutional position squaring in the Asian session. SHFE inventories have collapsed to just 318.54 metric tons, the lowest level since 2015, after shedding 31.3 metric tons on February 8th alone. Shanghai silver premiums over COMEX remain at $7 to $8 per ounce, or roughly 11%, reflecting acute physical demand stress. The fact that physical silver in Shanghai trades at a persistent and growing premium over Western paper prices tells you that the physical market and the paper market are increasingly disconnected. On the Fed front, core PCE inflation came in at 2.5% on February 20th, the lowest reading since March 2021, reinforcing rate cut expectations. Multiple rate cuts are still priced for 2026. The dollar index continues to weaken, down approximately 8.5% over 12 months. A weakening dollar is structurally bullish for dollar-denominated commodities, including silver. And here is the backdrop that ties all of this together. The Silver Institute confirmed in their latest report that 2026 represents the 6th consecutive year of structural silver supply deficits. 6 years running, the world has consumed more silver than it has mined and recycled. The cumulative shortfall now exceeds 800 million ounces. That is not a temporary dislocation. That is a structural reality driven by 2 forces that are not going away. First, industrial demand continues to grow relentlessly. Silver paste now accounts for nearly 30% of the total cost of a solar cell. Global solar installations consumed over 230 million ounces of silver in 2025, and that number is projected to grow. Every electric vehicle uses roughly 1 to 2 ounces of silver. Every 5G base station uses silver. Every satellite uses silver. The electrification of the global economy is a silver-intensive process, and there is no commercially viable substitute at scale. Second, mine supply cannot respond quickly to price signals. It takes 7 to 10 years to bring a new silver mine from discovery to production. 70% of silver is produced as a byproduct of copper, zinc, and lead mining, which means silver supply is largely determined by the economics of base metals, not the silver price itself. Even at $91 an ounce, the supply response will take years to materialize. The deficit is structural, not cyclical, and 6 years of deficits have progressively drained above-ground inventories at exchanges, in ETFs, and in industrial supply chains. Now the mining stocks, because the leverage in silver equities today was extraordinary. First Majestic Silver, ticker AG, printed what appears to be a new all-time high, trading at $30.26 on volume of 23.8 million shares. The stock was $5.09 1 year ago. That is a 413% gain in 12 months. First Majestic reported Q4 revenue of $463.9 million, up 169% year over year, with net income of $105.2 million versus a loss of $13.5 million in the year-ago quarter. H.C. Wainwright raised its price target to $30. The stock has blown through that target today. Pan American Silver at $65.36 reported record full year 2025 net earnings of $980 million. They raised their dividend 29% to 18 cents per quarter. Q4 EPS came in at $1.11, beating estimates by over 30%. They also completed the acquisition of Mag Silver, adding the high-grade Juanicipio mine to their portfolio. Cash flow from operations in Q4 alone was $554 million. These are numbers that would have been unimaginable 2 years ago when silver was trading in the mid-20s. Hecla Mining, at $23.64, posted record Q3 revenue of $410 million, up 67% year over year, with silver all-in sustaining costs of approximately $11 per ounce. They sold the Casa Berardi gold mine to focus exclusively on their highest margin silver operations in Alaska and Idaho. When silver is trading at $91 and your cost to produce it is $11, the margins are unlike anything these companies have ever experienced in their corporate histories. And yet, analyst consensus models for these mining companies still assume silver prices of $25 to $50 per ounce. The Street has not updated its models. When it does, the earnings revisions and the corresponding stock repricing could be dramatic. The Global X Silver Miners ETF, ticker SIL, traded at $111.70, up 1.39%, after delivering a 142% return in 2025. SLV, the iShares Silver Trust, traded at $79.08 with a year-to-date gain of 20.68% and a market cap of $44.4 billion. Sprott Physical Silver Trust, PSLV, holds 214.7 million ounces of allocated physical silver in the Royal Canadian Mint. Now let me give you the honest bear case, because if I do not do this, I'm not doing my job. First, the CME halt may be exactly what CME says it is, a technical issue. Exchanges run on complex infrastructure. Things break. Attributing conspiracy to what may be mundane IT problems is a cognitive bias that the precious metals community is particularly susceptible to. I am flagging the timing and the precedent because you deserve that context, but I am not asserting causation. Second, the March open interest drop to 22,966 contracts means the delivery pressure is significantly lower than the worst-case scenarios that were circulating in early February when open interest was above 85,000. If the remaining contracts roll or close before Friday, the delivery stress could be manageable. Robert Gottlieb, who has more experience managing physical deliveries than anyone I can cite, is explicitly saying the roll has been orderly. Third, silver's implied volatility remains extreme. When options are pricing 100% annualized volatility, that works both directions. The January crash from $121 to $64 in roughly a week proved that silver can give back 40% faster than most traders can react. A leveraged long position in this environment without risk management is not investing. It is gambling with asymmetric downside. Fourth, the structural demand narrative depends heavily on the solar industry's continued growth and China's willingness to maintain export controls. An economic recession would reduce industrial demand. A policy reversal from Beijing could reopen Chinese silver exports to the global market. These are not probabilities I can assign, but they are risks that a complete analysis must acknowledge. Fifth, the analyst targets making rounds right now, $309 from Bank of America, $150 from Citi, $6,300 gold from JP Morgan. These are based on balance sheet math and historical models that are genuinely valid, but valid in timeframes that may extend years beyond most people's planning horizons. Being right about the direction while being wrong about the timing is how people with correct theses go broke. Howard Marks has said this. Stanley Druckenmiller has said this. Every great investor who has ever lived has said some version of this. Patience is easy to preach and difficult to practice when you're watching a position swing 10% in a single day. Risk management is not optional. It is the only thing that separates investors from gamblers. In silver at $91 with 100%, implied volatility demands risk management regardless of your directional conviction. Here is where we stand. Silver closed today above $90 for the first time since the January crash. The CME halted metals trading for the second time in 3 months, 36 hours before the most active delivery month of the year. COMEX registered silver has declined 48% in 5 months to 87 million ounces. March open interest at 22,966 contracts represents 114.8 million ounces of paper claims against that 87 million ounces of deliverable metal. A former managing director of precious metals at 4 major bullion banks is publicly stating that the foundation for a sustained move higher is strengthening. JP Morgan just raised their gold target to 6,300. The gold-silver ratio has compressed to 57. Shanghai premiums persist at 11%, with SHFE inventories at 9-year lows. London lease rates are approaching 40%. Trump delivered a State of the Union that doubled down on the protectionist policies driving dollar weakness. And in the background, this is the 6th consecutive year of structural silver supply deficits, with cumulative shortfalls now exceeding 800 million ounces. The COMEX delivery data is public. The CME halt notices are public. The Shanghai premiums are public. Robert Gottlieb's analysis is public. The COT positioning is public. The options implied volatility is public. Everything I have walked through tonight can be verified by anyone with an internet connection in 30 minutes of effort. The ones who verify primary sources understand why February 27th matters. The ones who do not will learn after the fact. The next 48 hours heading into March 1st notice day will answer questions that the silver market has been building toward for months. Can the COMEX delivery system handle the demand pressure with 87 million ounces of registered silver? Will the remaining March contracts stand for delivery or roll? Will the CME halt have any lasting impact on market confidence? Will Shanghai premiums persist, narrow, or widen further? Will silver hold above $90, or will margin hikes and position liquidation force another correction? There is a date convergence happening right now that deserves attention. February 27th, March 1st notice day for the COMEX silver contract. February 28th, SHFE's deadline for all non-hedged silver positions to be closed or converted. And in the background, the ongoing constitutional crisis over tariff authority, the Fed rate decision cycle, and the US-Iran nuclear deadline, all creating macro uncertainty that feeds safe haven demand. The silver market has been in structural deficit for 6 consecutive years. COMEX registered inventories have been cut nearly in half in 5 months. Shanghai physical premiums are running at 11% over Western paper prices. London lease rates are approaching 40%. Mining companies are reporting record revenues at all-in sustaining costs of $11 per ounce, while the metal trades at 91. Options markets are pricing 3 sigma tail risk while spot consolidates. A former managing director at 4 major bullion banks is on the record saying the foundation for higher prices is strengthening. JP Morgan targets gold at $6,300. Bank of America targets silver at $309. And the CME has now halted metals trading twice in 3 months, both times within days of major delivery deadlines. These questions will not be answered by me or by any analyst. They will be answered by the market. And the market speaks loudest on first notice day. This is financial warfare education, not advice, not a signal, not a call. Verify everything, check the sources, do the math, and understand that what is happening right now is not noise. The data is all public. The patterns are all documented. The only question is whether you take the time to look. Invest with logic, not hype. I will see you on the next one.